come and he's gone, and he's announced his decision together with that of the Monetary Policy Committee of the South African Reserve Bank. No change in the repo rate for South Africa. Let me get to my panel of experts. Annabel Bishop is in studio with me. She's Chief Economist, Investec. Thank you, Annabel, for coming through. Vishal Rama, Quantitative Analyst at Prescient Investment Management, joins us on Zoom, as well as Botha, Head of Fixed Income at Ashburton Investment. Gentlemen, thank you for your time. Annabel, your thoughts. I wanted to ask a very easy question to you. Missed opportunity in your view?
I think it is a missed opportunity because inflation's actually very weak. I noted with interest the Reserve Bank said one of the reasons it's revised up its inflation forecast has actually been on the back of pressure from food price inflation. But we saw in the latest print that it actually came down. Food price inflation dropped from 5.7 to 5.2, and in fact there was very little pressure on that score for processed food price inflation actually falling. So overall what we're really seeing is some caution from the South African Reserve Bank in a very weak inflation environment. The print also lowers the inflation outcome likely for the rest of this year, probably to well below 4%. And of course, looking through next year as well, inflationary pressures are very, very weak. The economy is exceptionally weak. And of course, if you look at the demand pull pressures, if you will, very weak as well. Yeah. The only jump up we've had recently was on electricity, and again it's quite modest. I think that we're not getting second round effects from high electricity prices. I expected the Reserve Bank to look through that and not be overly concerned. So Godfrey, I would agree with you, it's a missed opportunity.
So from an economic perspective, what would you say about the governor's reasoning for keeping rates where they are? Does that make economic sense in this environment that we are in?
I think the governor, is finding the introduction of the new inflation target.
That's what this is about.
Yes. Yes, and I think that's being eased in, and they did make mention of the fact that inflation expectations didn't come down by as much potentially as they would have hoped. But it's early days. You often see a slow start and then a more rapid acceleration as you move towards the inflation expectations becoming entrenched much lower. So unfortunately, there is an over degree of caution I feel at the moment. There's no reason I think to really worry about inflation, given that it's absolutely flat if you look at demand. So from that perspective, I think that perhaps they're rather deferring to a November interest rate cut, but they really, I think, have unfortunately not delivered what would have been really good for markets today.
So we're paying the sacrifice ratio, let's call it, because this is the new buzzword, right? The cost of not cutting rates when you could have cut rates.
I think, the South African economy, we saw that little bit of a revision, 0.9 to 1.2. It's still a very weak economic growth environment, around 1%. What that really talks to is that it's not sufficient to create jobs. And of course, we need to see substantially fast economic growth towards 3%. Cutting interest rates by 25 basis points is not going to get us there. But it all helps. It all helps the consumer. And of course, we've seen in the United States much more action on a dual mandate, looking at both labor and growth as well as inflation. So unfortunately, there is this highly restrictive interest rate stance in South Africa. If you look at a 7% repo rate and inflation at 3.3, you're far wide of the mark of a 2 to 2.5% neutral real rate. Unfortunately, this is still constraining the economy.
And that interest rate differential has just grown by them not doing anything. Vishal, come in, your view in terms of what this non-action, let's call it this way, represents, and what perhaps the governor is looking at here. I'm suggesting, together with Annabel, that this is about that inflation target getting to 3%.
Thanks for having me. 100% agree, right? I think definitely, as Annabel mentioned, it's about easing towards this new inflation target, which the governor is sort of trying to get towards. However, having said that, and agreeing completely with what Botha said, definitely a missed opportunity, given that inflation expectations are fairly sort of contained over the next while. So, look, definitely should have been probably cutting today, but probably looking forward ahead to probably next year to possibly cutting maybe November. I mean, the farm market indicates next year is probably the next time that there is going to be cut. So we'll see, and hopefully that comes sooner rather than later.
Absolutely. Albert, come in as well, and I've no sight of the fixed income market in terms of the price action after the decision that was announced. Maybe you can, if you're able to give us a quick take, that would be great, but I just wanted your thoughts in terms of the decision that we got today.
So on the decision side, I have to agree with the panel. It feels like it was a missed opportunity. We saw inflation coming down, surprising to the downside, 3.3 versus 3.6. We are in a weak growth environment, and importantly, I mean, we saw the US cutting. So there are several things lining up that would have made this an opportunity for them, and I think it was a bit of a missed opportunity there. I think the markets will effectively try and see over the next couple hours and days effectively what they see. We're going to see what the US market does when it opens in the next hour or two. But I think they had the opportunity to cut. The rand is very strong. So it was a bit of a missed opportunity. I think a cut would not have created any ructions. And as of last night, as of yesterday, before the inflation surprise came out, I would have been much more on the fence that it should be a 50-50 call. But after that downside surprise in inflation, I honestly thought it was going to be a kind of a home run scenario for a cut today.
So from your perspective, does this perhaps put the Reserve Bank, I won't say under pressure, but does it give the Reserve Bank greater room to perhaps go for a jumbo cut come November?
Actually, I don't think that the Reserve Bank will do 50 basis points in November. I think that if anything, we'll see one cut then. It does certainly put them under a little bit of pressure to cut if November, especially if we potentially see some more cuts in the US. The markets in the US have a number of cuts priced in through the end of this year and into next year. And if by chance there's another cut in the US, it's certainly going to give the governor space. But with how sensitive and how conservative the governor and the Reserve Bank has been thus far, I sincerely doubt that they will see a jumbo cut to 50 basis points in a November meeting outcome.
Yeah. How probable, Annabel, is it that the Fed could cut 3 times? How many? Let's be conservative and say 75 basis points, and we only cut by 25 basis points. And I'm talking here the picture to the year end, right?
Yes. So including yesterday's move.
Exactly.
Yes.
Yeah.
So the markets have got a greater probability of the Fed cutting at the last 2 remaining meetings this year by 25 basis points, as obviously we've had yesterday. And unfortunately, our Reserve Bank is still hawkish. They might put through dovish forecasts. They have become a little bit less dovish. They certainly have talked a great talk about cutting interest rates, and that the new inflation target means that we're going to have lower interest rates. You're going to go into interest rate cut environment. We wouldn't have been in with a higher target, but that hasn't happened. It hasn't transpired, and consumers and the economy are suffering. You get business confidence lift when you have interest rate cuts. It's good for the property market. It's good for equities. It's good all round. Obviously, there is an impact on those on a fixed income, but from that perspective, obviously there are ways to hedge and obviously earn different forms of income. That aside, and your question really on the Fed, we think that they're probably more likely than not at the moment would look for more cuts. But again, it really depends on what's happening as you get there closer to the time. What's really interesting is that there is going to be a lagged effect of these tariffs on labor, and it's not going to be mollified. It's not going to be, removed by the interest rate cut that we've had, the one cut. There needs to be more cuts in the US to be supportive. South Africa has been struggling under structural issues. We've had many different reasons for weak growth, and obviously for the problems we've had in the freight crisis, the labor markets. But nevertheless, there is little to no reason why we couldn't have cut. And it's just excessive caution. I think it is unfortunately the hawkish nature that we have had, and it's not doing South Africa good.
I'm making my case for a 50 basis point cut in November.
I don't think he will, unfortunately, because the Reserve Bank themselves are very much led by the governor, and they tend to be quite hawkish this time round. So you might have to be disappointed.
Vishal, please come in and rescue me here. I'm suggesting that the governor and the MPC have painted themselves into a corner, because I'll make the argument again. If the Fed cut last night like it did, and it cuts twice more, and we've been conservative and saying 25 basis points, that's 75 versus the potential 25 basis point cut for us. Surely, They'd have to cut by 50 basis points.
I mean, just going by today's meeting and the outcome of that, I can't imagine a 50 basis points cut at the next meeting. I think we'll get lucky if we see a 25 basis point cut at the next meeting. I think, if anything, it probably transpires next year, and they'll just see for the remainder of the year how inflation settles. And definitely not a 25 coming in December. Sorry to disappoint you.
I can see that I'm way on my own here. What about next year for the Fed and potentially for the South African Reserve Bank? Because we saw last night the Fed suggesting that there might only be one cut next year. We know the markets have been expecting many more. Perhaps that will change. But I wanted to ask the question in relation to what potentially, therefore, that means for the South African Reserve Bank should the Fed just cut by one time. Sorry, Vishal. Vishal, I'm continuing with you. Yes.
Yeah, look, I mean, I think the expectation in the market is that the Fed, they have two hikes, two cuts priced in on the US side. So over the next two meetings, and then they will then probably look the next year to possibly cut further to that. I think generally speaking, the SARB sort of, as was mentioned by the panel, maybe missed the opportunity now to sort of follow and go ahead and, sort of that perfect platform to be cutting rates, to go ahead and cut at today's meeting. I think we will probably see them then following on next year and looking to cut by 25 basis points. But, if we don't end up cutting this year and the US now then cuts by 75 basis points, I think, that differential between the SA and US becomes a little bit more wider and maybe a bit more attractive for maybe foreigners coming play in SA. But, having said that, I think next year there's definitely scope for them to be cutting rates. And, what is quite interesting as well was that, the governor mentioned that even moving to this target lower of from 4.5% to 3%, their projections are that they will actually end up cutting. There will be more cuts actually priced in, so lower terminal rates. So wait and see how that develops and pans out. And we'll take it from there.
And he always tempers it, of course, by saying that this is a machine. We will look at data and decide how we move forward. Albert, I wanted your thoughts on the very same question as well.
So at the moment, the market is pricing in a terminal rate at the Fed somewhere in the order of 3, which is a number of cuts from where we find ourselves, right? We also have the central bank, the SARB, probably pricing in between 3 to 4 cuts over the next, say, 12 to 18 months. And we are likely going to follow around with that. But it is a case that the more the Fed cuts, the more freedom the SARB has. The more optionality the governor and the SARB has to cut rates. You asked the question earlier, what would it take for us to cut by 50 basis points? And you mentioned that the SARB is a machine. If we get another couple of inflation surprises in South Africa, if they see a situation whereby growth surprises on the downside and we potentially see inflation surprising on the downside for the next 2 inflation prints, and the Fed cuts by, let's say, another 50 basis points from here to December, then, 50 basis points might be in play for December. But even then, I think the SARB governor will struggle to do more than 25. The risk for any of these governors of policy error, right, is relatively great. There's a decision-making framework where they talk about one-way and two-way doors. And a 50 basis point cut is a one-way door, right? Once you've made that decision, it limits your follow-up decisions. Whereas a 25 basis point cut is a two-way door. You can always cut another 25 basis points in 2 months. And it's one of the reasons why the Fed governor is as conservative as he is, because a series of 25s gives him more options than a big 50 in December might.
Absolutely. If my jumbo cut comes through, I'm going to come calling on all of you guys. I'm just putting it out there. I wanted to sway the discussion a little bit and focus on the growth picture, Annabel. So he bumped up his growth forecast I want yours, and I want to know if you are convinced about his reasons for bumping his up, and whether potentially we could be perhaps looking at stronger growth going into next year.
Yes, well, the first half of this year, we saw economic growth at 0.7% for Q1 and Q2 versus the same period last year. That means for the second half of this year to reach 1.1% growth for this year, not 1.2.
Yeah.
We need to have 1.4%.
Right.
In the second half of this year versus the second half of last year. And in fact, if you want to obviously go higher, you need to obviously have a higher growth rate the second half of this year.
Sure.
And of course, what actually happened was in the second quarter, we saw statistical base effects come through from the very weak first quarter. We had GDP growth of 0.1% in the first quarter.
Yeah.
If you take out the agricultural sector's outperformance, GDP actually contracted by minus 0.3% in the first quarter. If you take out that base effect and the impact of agriculture,
Yeah.
which is a tiny sector,
Yeah.
but because it has such enormous moves, either way, it can
Yeah.
have a big impact,
Yeah.
then the second quarter would only have recorded economic growth of 0.4%.
So you're not changing
such
your number.
such a big base effect.
Yeah.
So, what we are changing our number on the back of instead is something different, and that is that we've actually seen a very interesting outturn this year from tariffs coming in already in April for vehicles, 25%, and while exports are down 85% to the US in the
Yeah.
first half of this year,
Yeah.
from the tariff effect, we actually see overall exports are up about 8% for vehicles globally. So there's been alternative export markets
Yeah,
found. We
yeah.
believe that minus 0.1 to minus 0.2 that we took off GDP growth because of the tariffs might not actually transpire because agriculture is a necessity, so there might be less impact there, and also easier to find alternative markets given that they're cheaper items. But
Yeah.
also, of course, as well, we do have a situation where most of our mineral exports into the US tend to have little tariffs on them.
Yeah, they're tariffed, yeah.
So overall, we might actually find about a 1.1% outcome for this year.
Okay, 1.1% this year. Follow-up question to that would then be, I was actually going to ask around the better than expected retail numbers that we saw the other day. Would that factor in as well?
Very interestingly, and so much is on statistical base effects, they actually would have come out at 2.1%
Yeah.
and not, above 5.5%, had you not had a collapse in retail sales a year ago.
Yeah.
So actually, they weren't phenomenal outperformance. It was just that base effect coming through again. So, if we look at where it came from, general dealers actually saw a contraction of about 10.9% a year ago.
Yeah.
And that substantially pushed up the general dealers year-on-year outcome. And of course, that's the most heavily weighted category, close to 50% of retail sales.
Yeah.
So unfortunately, it doesn't show a strong consumer. It's a misnomer if people were to believe that.
Gotcha.
Instead, it actually just shows a more normal retail sales outturn of closer to 2%.
Yeah. While we were talking, the rand has been moving. 1743, we are talking about now. Remember, we were talking about 1733 at one point during power lunch, and then we moved out to 1739, now 1743. Clearly, a weakening bias that we are seeing. Vishal, I wanted to know how the market is interpreting this from your viewpoint, given the weakness that we're seeing creeping into the rand now. On the equities front, we really have lost most of the gains that we had, and we're now sort of flatlining.
Yes, so market may be a little bit disappointed that they probably didn't cut. I know that consensus going into the meeting was for there to be sort of no cut at today's meeting. That was what most people had projected. That was obviously before the surprise on the CPI yesterday. So market waking up this morning was a little bit stronger on the bond side. Have a post the meeting, it sort of came back to flat. So nothing major going through right now, particularly in the bond side of things. I think going forward from here, we'll wait and see. I think what the FOMC does, and we'll see how the data comes out of there, and then the market will react according to that. And I think SARB will also take guidance from that as well.
Albert, your viewpoint as the bond man?
So these things are always very, very more intricate, I think, than a lot of people realize. If you look at, for example, the US 10-year, it was trading about 4% yesterday. It's currently trading about 4.12. That's up. Higher yields on that side tends to lead to a stronger dollar as more people want to invest there, and that can negatively affect the rand. It could be potentially that some of the investors were a little bit disappointed about the lack of a cut. But I think it probably has more to do with some of the US factors. The cut there their higher yields and potentially some risk-off behavior. We've also seen in South Africa our bonds are slightly lower after this announcement, and it might just be a case that we see a lot of people taking some money off the table, taking some money out of the country. We have been trading very, very strong in the rand. The rand has certainly traded into an area that could be described as somewhat overvalued in the 7.3, 7.4 kind of space. And I think there's quite a few analysts, if you ask them where they see the rand trading a year from now, it's probably closer to 1780. It's important to note that at 1730, 1740, the rand is stronger today than it was 3 years ago, right? So the rand is quite strong relative to its recent history. And some retracement on that is not necessarily a reflection of what the governor did today, because at least in theory, higher rates should lead to stronger currencies. So when that doesn't happen, it's quite often because something else is going on.
Absolutely. So I actually wanted to ask the two analysts that we have here with us. Annabel looks at the rand, Vishal looks at the rand. I want to ask them actually where they see that currency going now that the cut has not happened and the Fed cut last night happened. Annabel?
Look, I still think it greatly depends on what happens with the US dollar. So the vast majority of strength this year has been to US dollar weakness. And, obviously that's the rand against the US dollar. So if you actually look at the strengthening, it's been about 10%. The rand's actually, that's the weakness of the US dollar, and the rand's actually strengthened by about 8%. Sure. So what that really means is the rand hasn't even strengthened as much as the US dollar has weakened. Right. And of course, as you know, interest rate cuts in the US do tend to result in a weaker dollar. Yeah. This time around, it seems to be a bit of a flattish reaction. That's because markets were actually very worried about economic growth. Right. In fact, one reason why we've had a weak dollar this year.
Yeah, but what about the 25 basis point differential now that we've just gained now?
Yes. So that
Would that make a difference?
That should result in some rand strength. But what we have seen in the past sometimes is that when markets were hoping for a cut, even if they hadn't factored it in, but remember, it was very new, this inflation outcome yesterday, and it hadn't really worked its way through the system yet, of hope for a lower interest rate on the back of the downside inflation print. So what that means is that, we probably should have seen, a bit more positivity on the rand, and the rand actually went to 17.26 last night after the Fed cut, but unfortunately weakened quite a bit since then. I think there is disappointment that we didn't see a cut. It will certainly reflect in equities, foreign investment into our markets, and of course, there is again this global investment into emerging markets, and if South Africa doesn't benefit, the flows are actually going elsewhere. Given that we still see very high bond yields in South Africa, you might see some foreign buying, and then we have seen, but overall, we are less attractive destination than many other EMs, and unfortunately, our weak growth environment's really coming to play.
Yeah, I had someone from ABSA earlier, and they were saying they were looking at perhaps potentially 17.20 on the rand. I think that's what they said. I'm going to come for your number, Vishal.
Yes, so we don't actually make sort of point estimates for where the rand will kind of be. I think, as mentioned, the rand has done quite a lot over the last while. And I think it's also very difficult to sort of disaggregate today's disappointment with regards to not having 25 basis point cut with what happened with the FOMC last night. So rand has now come to around 17.40, still very attractive levels, very strong levels. I think if we see probably by the end of this year, rand will probably trend around this sort of level over the next while. And I think, as mentioned, it's not a isolated or very specific factor towards South Africa. It's a whole EM basket. That whole basket has come down quite a bit over the last while, and there probably is scope for more to occur, given that SA has probably not been at the forefront of that strength. Your Brazils, your mix have done a lot better and a lot stronger in their currency over the last change. We're probably just in the middle range of that, right? So I think over the next while, probably hover between 17, 50 for the remainder of the year.
Okay. Albert, from your perspective, just in terms of what this means for the bond market, this is positive, right? The inaction? Inaction, I'm saying, but it was action.
It was action or inaction. So from a bond market perspective, it's higher rates means, at least in theory, that long-term inflation should be a little bit more under control, right? Yeah. From a spending perspective, the fact that rates remain slightly higher. If you think about government has been raising a lot of money in the T-bill market, that might have helped them on that side. I think in practice, our bonds have run extremely hard the last couple of months. I think that if you take into account that many of our bonds were yielding above 11% in April after Liberation Day, and many of those same bonds are now yielding 9.3 to 9.4%. We have had an absolute historic bond rally, way past, I think, what many people thought we could do. I think from a long-term perspective, I don't think that this current decision is going to add further impetus to a massive bond rally from where we are at the moment. But the positive you can take out of this is I think the governor continues to focus on the inflation rate, and he doesn't want an inflation rate runaway, which for the bond market broadly should be pretty decent. But the other side of it as well is the fiscal side. And we've seen a little bit already that some of our local bonds selling off. And if the bond market determines that there's a bit too low a growth outlook, it might actually hurt us on the other side. It's not clear cut that this is going to be purely positive one way or the other. I think it's going to be interesting to see effectively to what degree the bonds move over the next couple of days and weeks. But I think that on a net basis for your nominal bond exposure, this should be at least broadly positive as it means that inflation rate is likely to remain contained and that the governor has and maintains a very strong inflation focus.
Absolutely, and your yield differential bumps up a little bit by 25 basis points. I'm sure we must count ourselves lucky that we don't have a finance minister who complains and says, you must lower interest rates. Your rand price for the year end?
So we think that towards the end of this month, certainly once the decisions from the Fed and the South African Reserve Bank are fully priced in, certainly over the course of next month, we could see the rand trying again to move towards the 17 rand to the dollar mark. It's a very strong resistance level.
Did you say 16?
17 rand to the US dollar mark. It's a very strong resistance level. And, if we actually saw it already at 17.25, not being able to get there. So, there are these very, very, very big levels where profit taking occurs. Of course, as we move towards the end of this year, and particularly if the Fed does deliver 2 more 25 basis point cuts, yes, I do think we could start to see the rand trying to break through the 17 rand to the US dollar level. Remember that the purchasing power parity value of the rand is 16 rand to the US dollar, and actually in 2022 in April, the rand is at 14.50. So, we've had that big run up in the weakness of the rand, higher interest rates globally. Now we're on a downward trajectory still with global interest rates, even though there was a lengthy pause that should deliver further rand strength.
Absolutely. Well, we wait and see. Let's see if we do get to that level. Annabel Bishop, thank you, Chief Economist at Investec. Vishal Rama, Quantitative Analyst at Prescient Investment Management. Thank you, sir. Albert, thank you, Head of Fixed Income at Ashburton Investments. Thank you all for coming through. That's our broadcast of this Monetary Policy Committee meeting of September, where the governor delivered broadly what the market had been expecting and disappointed some that we're saying it might have been time to cut. 1 minute past 12 is your time. On the other side, it is closing bell, East Africa.